Welcome back to Women in Finance. Today, we are going to discuss Module 4, Section 6 and 7, where we will talk about financial ratios and the concept of ESG. Financial ratios help us understand the health and performance of a company. Let's start with the liquidity ratio. The liquidity ratio measures the ability of a company to repay its debt and other liabilities. If a company has a poor liquidity ratio, that means it will likely struggle to repay its debt and other working capital liabilities. Next up is the leverage ratio. This ratio measures whether a company has high or low levels of debt compared to its business. The efficiency ratio measures how well a company utilizes its assets and resources. Next, the profitability ratio. This measures a company's ability to generate profits relative to its revenue, balance sheet assets, operating costs, and equity. If a company has a high profitability ratio, that means it is more efficient. And lastly, the market value ratios. These evaluate the profitability of a company relative to its valuation. And now let's move on to Section 7, where we will talk about the concept of ESG. ESG stands for Environmental, Social, and Corporate Governance. This is a framework that we use to evaluate companies based on these three criteria. Firstly, we will consider environmental factors. This means that we will evaluate a company's impact on its environment, like carbon emissions, waste management, and resource usage. Next up are social factors. This includes a company's impact on society, including employee relations, diversity and inclusion, and human rights. And lastly, we have governance factors, examining a company's management and decision-making capabilities. This means examining the board's composition, executive compensation, and shareholder rights. So why does ESG matter for investments? It allows us to consider non-financial factors when making our investment decisions. It can not only help us identify companies that are financially stable and well-managed, but socially responsible and environmentally sustainable. This can actually lead to better long-term performance. Sharia-compliant investing can also be included in the ESG investment framework. Research has consistently shown that companies with high ESG standards tend to perform well. In fact, their stock prices might outshine the rest of the market. And this is why many investors now focus on companies with high ESG rankings. In Pakistan, corporate governance plays a vital role in determining the investment risk and returns. There are various cases of fraud, especially in unregulated sectors like real estate. That is why it is really important to do a background check on the management and owners of the company. So how can we evaluate all this? Well, by examining historical track records, dividend payments, and the treatment towards minority investors. Additionally, having a higher number of women in senior management and board position actually correlates with better business performance. All this information is usually available in the annual reports of companies, providing a comprehensive view of their commitment towards ESG principles. And with that, we have explored the world of financial ratios and ESGs. Understanding these aspects not only improves our analytical and evaluation skills, but also enables us to make better socially responsible investment decisions. So, until the next lesson, happy investing!